Hello everybody and welcome to the second of our finance webinars this morning, developed as part of our Money Matters series. My name is Aileen Deasy, Manager on the Enterprise Development team, and we are delighted to bring you this important finance webinar today. So thanks a million for taking the time, and it's really great to see so many of you tuned in today. We know that this is a really important area for all businesses as we move from survival to recovery. And we are acutely aware of the challenges that you've been facing, especially with rising costs and the impact all of this is happening on the bottom line of your businesses. So to help you navigate the current financial environment, this webinar is focusing specifically on managing your cash flow and repairing the balance sheet. So on to the business of the day. I'm delighted to welcome our two experts here today from Crowe. So we have Maria. So Maria is Director of Hotel, Tourism and Leisure in Crowe. And Maria has over 20 years experience in the industry and consulting experience in the hotel, tourism and leisure industry. Maria has held senior positions in the hotel sector and has an in-depth knowledge of the sector, both operationally and financially. So welcome, Maria. And we're also joined by Aidan Murphy. So Aidan is a partner with Crowe, working in the corporate finance department. Aidan is a fellow of Chartered Accountants Ireland and a member of the Representative Committee of Restructuring and Insolvency Ireland. And Aidan's expertise is particularly in relation to areas like debt financing, business liquidity, cash flow management, capital appraisement decisions, and strategic business planning. So we're delighted to have you both. And over to you, Maria, and I'll see you later for the questions and answers.
Thank you, Aileen. Good morning, everybody. We are going to cover just a few topics today. We thought really what we would do is just, I suppose, do a market overview, and that's really just to set some context about where the industry is and maybe where the industry is going. Turnover levels then in Irish hotels. We'll do a scenario as well, like what a hotel looks like, you know, a typical Irish hotel 2019 and how it's moving forward, look at its balance sheet and its cash flow statement and what impact that has on how it manages its business. And then managing cash flow, like that's the key element here today, really looking at costs and managing your cash flow. And then what's next for the industry. So to start with, what we thought we'd look at is the market overview. And the reason we do that is any business, you know yourself, really important to look at your external environment. You know, a lot of times we look inwards and we look internally, but the external environment, as we know, more than anything, has a huge impact on our businesses. So we have four, I suppose, topics here that we were looking at. Maybe Aidan, you'd talk us through these, what you think about these headings.
Yes, in terms of, I suppose, the post-pandemic economic recovery, we're expecting obviously a strong rebound. But I suppose the question for people on the webinar will be, how quickly does my business recover? People I talk to all have the ambition of getting back to 2019 levels, but what we'll find is the world is a different place. Our cost base in 2022 is much different to what it was in 2019, and therefore, you know, that's going to have a big impact on our profits. That really is driven on the cost side in terms of supply chain disruption, and that covers not only goods but also, I suppose, services. So labor, you know, is one of the big inputs in any of our businesses in the hospitality sector. It can account for up to 40% of costs. So during the pandemic, you know, a lot of our workforce, you know, went to other sectors. Some went to their home countries, so we have to rebuild our teams. And in terms of looking at, you know, what we can do and rebuilding revenue, that's going to be a major challenge because we just haven't the people to be able to support that. And that's going to limit, I suppose, on our growth. Energy was a big issue in 2021 in terms of costs increasing, and that's going to, I suppose, continue into 2022 and thereafterwards. And insurance for properties, you know, the market there has changed. There are less underwriters in the market, so we're seeing large jumps in terms of premiums. So we've all of these, I suppose, costs rising quicker than revenues can rise, and and that's going to hurt, I suppose, or is hurting, I suppose, profitability within our businesses. You know, I suppose we could cope with some of that, but the Ukraine, I suppose, Russia war, what does that mean for us? And that goes back to the point on energy. You know, we've seen big increases in 2021. We're seeing more large increases in terms of costs coming at us, and we just can't, I suppose, pass these costs, I suppose, on in terms of higher prices. We're going to have to look at ways of having a leaner business to save money elsewhere, and we'll discuss that, I suppose, over the course of the webinar. That very much, I suppose, leads us into the whole area of sustainability. First, I suppose, our customers are also suffering from higher energy costs. They're changing their daily lives, so there's a greater awareness around sustainability. So it'll have a higher priority for them, and they'll want to see, I suppose, the businesses, the hotels, the guest houses show what are they doing, I suppose, to conserve and save energy. And it also feeds in to how we reinvest, because we're always reinvesting in our businesses. And in terms of reinvesting in the businesses, you know, should we be reinvesting in areas which is going to bring cost savings rather than maybe just improving, I suppose, the amenity factor? So, for instance, there, like, could there be a choice between, do we replace the carpets or do we replace the windows? The amenity value certainly will increase with new carpets, but we may, you know, the hotel certainly would be cozier with new windows, but we'll also save on our energy bills. So I think with, you know, limited you know, funds available for reinvestment, sustainability and, I suppose, making the choices around that will be important.
Thanks, Aidan. I think as well, though, with sustainability, it can be smaller things, you know, looking at the business. I mean, I think it can be smaller things as well as not just the bigger elements. But it leads, like the points that you made there, they're not to sound negative, but, you know, we've heard over the last couple of years that, you know, obviously the domestic market was really strong, and there's money in people's pockets. So do you think that, you know, that'll have a positive impact from the hotel's perspective? Do you think there's going to be spending by the domestic market in Irish hotels?
Yes, I think that's going to be very important. I think it's very important, certainly in 2022. Take my own, I suppose, kind of instance. I had more probably, you know, trips in Ireland in terms of weddings and, I suppose, family events where you're catching up with people in 2022. What I do notice probably is I'm paying a lot more for the accommodation in 2022 than I was in 2019. And in some ways, these trips are important, and I have no issue with that. I suppose going forward, you know, what will people's attitude be in 2023 and thereafterwards, when I suppose they have less money in their pocket, they're concerned about these higher bills, and, you know, will the number of trips, I suppose, you know, continue at the level they are at the moment, or will there be a level of fall off? And we just need to be careful around that. Also, I suppose the slide there looks at domestic trips for Q1 to Q3 back over the last number of years, and we had a record year in 2019. So businesses looking to get back to 2019 levels, you know, that 9 million trips from domestic consumers, that's a big ask over the next 2 or 3 years. And what's, I suppose, concerning there is in 2021, you know, as especially over the summer period, we had less trips, you know, in 2021 for the domestic market than we had in 2020. So it looks to me as if we've 2 or 3 years to get back to where we were in 2019, and we have to be careful, I suppose, in terms of pricing and cost, I suppose, to our customers, that we don't switch off demand.
So, but do you not think as well that, you know, when we look at those figures, and I would agree that like there's a lot of people left, and I think this year a lot of people are going to leave for their main summer holiday, but there's a pent up level of demand, like from a short break market, from the domestic, from weddings, you know, family events, functions. Like we didn't really get to have a lot of that over the last 2 years. So maybe there's a shift in what the domestic tourists will be going back to previous, in that it's a mix of both short break and holidays. Let's look at international visitors. Obviously, we had our peak year was 2019 again. Do you have any thoughts on when you think domestic or sorry, not domestic, international visitors will get back to that level?
I think what the graph kind of tells us long term, you'd be confident, that we will surpass where we were in 2019. And we've always, after a setback, I suppose, rebuilt numbers strongly. And going back, I suppose, to the issue of sustainability, I think that could be very good for Irish tourism in the long term, on the basis that not only will we have, I'd say, more tourists, we'll also have them staying longer, because I think they'll plan trips which are longer in the destinations that they choose. But most people on the webinar will be looking at, I suppose, the next 2 years, the next 3 years. I think IFIC have done a very good piece of work, and it really summarizes the position quite well. So here we have, I suppose, the negative case in red in terms of a recovery, which means that we're well back on where we were in 2019. So we see 2019 was 9.7 million visitors, aiming to get back to those levels under the negative case. It's well beyond 2025. We get close to it under the base case, and under the optimistic or positive case, we're there by 2024. So I think what we're seeing in terms of numbers is that arrivals are tracking about 35% below where they were in 2019, and therefore, you'd be hopeful that we can at least achieve the base case in terms of numbers, but that still means we're not back to 2019 levels till 2025, and therefore, I suppose, what's that telling me? That's telling me if the domestic market isn't as strong as it was in 2019, and the international market is not as strong, but then occupancy in our hotels will take 3 or 4 years to get back to 2019 levels. And in the meantime, I suppose we've had an extra 5,000–6,000 rooms added to the Dublin market, and Dublin was very much, I suppose, out of the numbers in terms of occupancy in 2020 and 2021 as events and activities come back into Dublin. But then I think that domestic market share will probably spread, not only from regional Ireland but also into Dublin.
So I think really what you're saying is it's forecasting. So when you're forecasting and when you're doing your budgets, it's really important to try to be as accurate as possible. And I know that that's not always easy, but look at your own, who is your business mix? Is it international? Is it domestic? Where is your business going to come from? So that, and be realistic as well in your projections. Don't expect to get back to 2019 revenue levels. That's what you're saying, as quick as maybe we would have liked. So just to be prepared, maybe that revenue levels might not get back to 2019 levels till 2025 or 2026, or that's really what we're taking away from that. Okay,
yeah,
so go ahead, yeah.
I suppose different hotels would be impacted differently by this.
Okay, so that's kind of the external environment. If we go to the internal environment, then let's look at I suppose the hotel market as a whole. What do Irish hotels look like from a trading market perspective? How much money do they make? How much EBITDA do they make in general? And you have a slide here that splits Dublin and regional Ireland from turnover. Let's maybe talk through this a little bit, and then we'll look at EBITDA.
Yes, so I think what this slide tells us in terms of the scale of businesses and the number of businesses is that more than half of our hotels probably have turnover of less than 3 million. And we know, I suppose, in the hotel sector that economies of scale play an important role. So I suppose the higher the level of turnover, the rule of thumb would be, I suppose, the higher the net profit percentage would be. Equally, I suppose, between Dublin and regional Ireland, what you find in Dublin hotels, there's generally a higher average room rate and a greater mix of room sales, and therefore there will be a higher net profit, I suppose, percentage. So here really, I suppose, we're looking at kind of which hotels will be impacted most by any increase in the cost base, and I think it's going to be more than half of our hotels will cost more than half of less than 3 million, and I suppose we can then consider what that impact might be.
Okay, so here's EBITDA then. So what is the, you know, I suppose 2019, like what was our EBITDA percentage for these types of properties, Dublin versus regional Ireland?
Yeah, and we just take two there. So we're giving the average EBITDA by turnover, I suppose, category for the Irish sector. But if we take regional Ireland for hotels with a turnover of less than 3 million, the average EBITDA or net profit percentage would be 13%. And I suppose the other side, the other way to look at that is that their cost base is 87%. So the concern, I suppose, would be with costs increasing quickly. So if a hotel in regional Ireland has a 5% in its cost base that it can't, I suppose, recover through higher prices or savings elsewhere, that could reduce its EBITDA level by 30%. So that 13% could fall to 9%.
Okay,
The impact
that's a lot.
for a hotel in Dublin is probably not as prominent in that, you know, because higher mix of room sales coming through, they're at an EBITDA percentage of 38%. So their cost base is 62%, and a 5% fall there takes them from 38 down to 35. And so it's less of an impact on their profit and less of an impact on their cash flow. However, there may be different issues at play there, in that they may have been purchased for a higher amount of money, they may have seen a refurbishment, they maybe have a high rent or a high level of debt, and therefore I suppose they need a certain level of cash flow to make sure, I suppose, that they can meet the commitments of the particular business.
Yeah, I was thinking that exactly. So let's take a accommodation scenario. So what we've done this morning actually is we have Hotel Crow, and this is a mid-priced regional hotel. And what we're going to show you is a P&L, you know, 2019 and then forecasted or projected for 2022, its balance sheet and its cash flow, and what the impacts, I suppose, of these changes in EBITDA mean. So this particular hotel, we've taken up a 100-bed hotel, so a good size hotel in a good regional location in Ireland, and in that bracket that you talked about, Aidan, that 3 to 7 million in turnover. An older property, so what does that mean? It's maybe some higher level of overhead, it's not as efficient, higher levels of repairs and maintenance, and a high level of food and beverage, which would be typical for many regional hotels. So their sales mix gearing towards the food and beverage. So looking at their P&L first here, there's what are you going to tell us about this property?
Yeah, I think the first column we'll look at will be 2019. But the ambition is to get back to 2019 levels, just to remind ourselves for, you know, the typical hotel, as you described, you know, its food and beverage mix is that, you know, its rooms sales would be 43%, food, beverage, other then would be 57%. So there's more in non-food or non-rooms than there is in rooms. Cost of sales are coming in at 30%, their direct costs of 8%. It's making a gross margin before payroll costs of 77%. Payroll costs running at 38% because we have a high food and beverage mix in the hotel. And our overheads, which would be our admin in general, our sales and marketing, our repairs and maintenance, our energy costs, running at 22%. So we were comfortably making 950,000 in 2019, and our EBITDA percentage was 16%. We, you know, recovered somewhat in terms of in 2021 in terms of starting to rebuild the business after being closed. But because of our location, we weren't, you know, a high tourist destination. Our occupancy is probably a little bit lower than maybe the market at the time at 35%, but that's over a 12-month period. Rate was stronger for the hotel. Food and beverage was down because the activity in the hotel was down. So we achieved a turnover of 2.7 million. We held our cost of sales in around 30%, slightly higher because of the lower volumes. We held our direct costs. So our gross margin stayed 77-78%. The big number, I suppose, that's changed is because of the payroll supports. Our payroll cost was just 600,000 after supports to do 2.7 million of turnover, and that came in at 22%. Our overheads tracked where they were previously because we could make certain savings, but a lot of, I suppose, the costs were fixed. So our EBITDA fell from 950 down to 400, and came in at 15%. And in some ways, I suppose, we were positive in terms of cash flow, positive in terms of profit, and in a difficult year, I think we were happy with that. So this hotel, in terms of, I suppose, framing its budget for 2022, has been somewhat conservative in terms of where things might be, but it's looking at turnover return recovering to about 80%. So I suppose the big numbers there are occupancy will be less than 60%. There's a good strengthening of average room rate in the market, and we're getting a recovery on food and beverage. Our costs are tracking as normal in terms of the gross margin comes out at 78%. What we're finding is there's a big increase in terms of our payroll costs. So we're looking at 41% payroll cost on the 4.8 million turnover, and our overheads were 1.3 million in 2019. Have now become 1.4 million because of cost inflation, and we're fully open. But I suppose that the concern here is, the business needs to be making a certain level of profit, and because costs have increased at a time when we're only recovering our revenues partially, instead of getting back to 950,000 of profit, we're only getting back to 450,000 of profit, and therefore, is that enough to cover the needs of the business? Is it enough, I suppose, to rebuild the balance sheet? And therefore, we need to look at those payroll costs. We need to look at the overheads. We need to really manage the P&L to be able to push that 450,000 back up towards 950,000 over the next year or two.
Okay, thank you. So actually, so let's go to the balance sheet, because that is the point, really, is that 450,000. Like, how is that going to, impact your balance sheet? So taking this particular hotel, and obviously a balance sheet is a point in time, but so that, in 2019, what we see there is obviously different to 2022, where there's the main differences we see are in the cash, the creditors, and the tax liabilities. So what has happened to this hotel over the 2-year period? Like, what have they done that's impacted their balance sheet?
Yeah, I think initially, at the start of the pandemic, they brought in some short-term loans. So that's the other creditors of 150,000 euros. Over the course of the pandemic, they were entitled to warehouse their taxes. So we can see their tax liabilities have gone from 150 up to 350,000 euros. They decided, I suppose, in 2021, because there was cash in the business, to reinvest. So the asset has gone from 9 million up to 9.2 million. And over the course of 2021, because they were interest only on their loan, they were able to build up cash in the business, and that's why cash has built up to 350,000. So at the point in time of coming into 2022, this business looks, I suppose, very comfortable in terms of it sees 350,000 in its bank. It's twice what it would have had back in 2019. But forecasting is very, very important, because how will these other liabilities wash out? What level of profit is coming into the business each year for the next 2 or 3 years? And where will cash flow be in 12 months, in 24 months?
Okay, so let's look at that. Now, we have projected cash flow, we've projected revenues, and then EBITDA. And we've been conservative, I think, maybe, like you said, about getting back to 950. But even if you're able to grow your EBITDA by, 3%, you can see that there it's going from 450 to 470 to 483. So what does a business do then about, those liabilities, the warehouse tax? How do they manage that now, so to get that off their balance sheet?
Yeah, and I think, in terms of the first, I suppose, distinction here is between EBITDA and cash flow, because, every business in the hospitality sector is reinvesting in their property. They're probably putting 3% of their turnover back in. So in terms of capex in any one year, for a business doing 4.8 million, we're reinvesting 144,000. We have to find the money for that. We've got to pay the interest on our bank loan, costing 140,000. We've got to pay the capital on the bank loan. So even though our EBITDA is 450 in 2022, after we look after those three items, we've only added 6,000 euros to the cash within the business. The providers of the short-term loan will be looking to have that repaid over a short term, so we're showing that over 2 years there. So 75,000 in the first year and 75,000 next year. And our warehouse tax from April or May 2023 needs to be repaid. So with 250,000 being repaid there, 180,000, 70,000. And when we run this model, I suppose, and it's somewhat theoretical, but we can see that the comfort of having 350,000 in the bank becomes 8,000 euros in the bank in 2 years' time. And I suppose that underscores the need to get that EBITDA number of 450 back up towards 950,000 and initiatives, I suppose, that will deliver on that.
Thanks. Aidan, we have written there, understand the interest rates. What do you mean by that? Like, how relevant is that? Is that in relation to the different types of loans you may have? Yes,
indeed. So I suppose in this example, we're looking at the warehouse tax being repaid to revenue over a 2-year period. They will have a facility whereby they'll allow that probably over a longer period for taxpayers who are compliant and have a good revenue record. The borrowing cost there might be 3-4% from revenue for the first 12 months of that, or maybe even for longer. And therefore, I suppose looking at what you can afford to pay back, equally with the short-term loans, can we stagger those payments out? If the interest cost on those is higher than the revenue debt, but then we'll pay those off quicker than we pay off the revenue debt. Okay, fair enough. That makes sense. Thanks. So I suppose let's maybe just get into a conversation about managing cash flow, because you've spoken this morning about increasing that EBITDA. So managing profit and cash flow is obviously down to two things: our revenues and our costs. So increasing revenues might take time as demand looks to increase. But what about costs? I mean, it's all over the news. All of the hoteliers know it, that costs are increasing. What are we looking at, I suppose, from an increase in costs? What are the main ones that we should be concerned about or really focused on? Yeah, I suppose we kind of called these out a little bit earlier, but we're looking at obviously wage inflation, not only I suppose shortages, but there's inflation in terms of the cost coming through. We're certainly seeing general wage increases up to 15% higher than what they were in 2019. And the question is, well, what needs to be absorbed? What can be passed on in terms of higher prices around that? Energy costs are certainly rising 20%, 30% per year, and maybe more. And we're looking at them rising much faster than prices will be rising. And equally, insurance premiums may be rising 15-20% per annum. And even on that, talking to one broker, they're saying to me that the building cost inflation is going to feed further into that, in that the rebuild cost of hotels is going up, and therefore the insurance, the value you have to insure will go up. And there are just less underwriters in the market, and there's no appetite in the market for any type of leisure business. So it is very much a difficult space where we are going to see ongoing, I suppose, cost rises. And I think for those three, they're higher than what we will get in terms of any potential maybe to increase prices. So there's a question there, and I suppose that is the big ask of many hoteliers. Can these increased costs be passed on? What are your thoughts on that? I think some can, because I think there's, I suppose, an expectation from consumers that prices are going up. So I suppose being transparent, I suppose, about prices and the needing to pass on some of these costs. But equally, there are a number of them that won't be able to be passed on. And therefore, if I go back to my cost base, which is 87% of revenues coming into my business, I've got to focus on well, how can I become more efficient in terms of that cost base? So if there are some costs which are going up quite quickly, can I find other areas to make savings? And I think that's going to be a big challenge for the next 12 months, next 24 months for hoteliers, if we want to be able to, I suppose, hold on to margin or build on the margin and not have to absorb too much of the costs.
Okay. We have two slides here actually where we've taken the scenario of our 2019 figures and we've looked at the implications of rising costs. So they're obviously hypothetical and they are almost worst case scenario to a certain extent. But if we look at these, what we see is that, so this top, 2022 rebased to 75% of 2019. So we've taken 2019 figures for, this is a Dublin hotel, 141 room average. So we've taken the per available room from our survey. And we've shown out, what the revenues, payroll, utilities, other costs, and the profit then at 2.3 million at 30%. We've rebased that to 75% of those figures to show what they could be for 2022 in our original budget or forecast, let's say. But what of these increasing costs that you've just talked about? So 75% of 2019 at 6.4 million in revenue. If we have an increase in payroll costs, our revenue is going from is going up 359,000. If we have an increase in utilities of 30%, which is worst case scenario, hopefully, that's 72,000. All other costs up 136,000. So that impacts our profit by 566,000 for a Dublin hotel. Like that money, 566,000 has to be found somewhere. And let's look at it as well for a regional hotel. Again, rebased figures of 2019. So obviously a smaller revenue level and profit percentage level down. So 3 million revenue rebased. So increasing payroll at 15%, that's 175,000. Increasing utilities by 30%, that's another 40,000. And all other costs by 5%, that's 60,000. So that's an impact of 278,000 that we're seeing on EBITDA values, and obviously then the percentage is reducing as well. So I suppose the question then is, we can see, and we're showing you that, costs are going to increase. It is absolutely going to impact your profitability for the year ahead. So what are we going to do, and how can we, as best we can, reduce those costs or improve or keep or maintain our EBITDA percentage? So I suppose maybe we'd go through some of those, Aidan, and get your thoughts on that.
Yes, and I think what's kind of important here is these costs are increasing very, very quickly. And I suppose in terms of increasing very quickly, when I talk to hoteliers, some have budgeted for these increased costs and some haven't. And I suppose part of the reason we're calling out these higher costs today is that we're asking, I suppose, hoteliers to relook at their budgets to make sure that they've adequately provided for current cost levels, so that they're making decisions, based on, I suppose, a good understanding of the costs. So in many ways, what we would say is the easy answer probably to how do I recover the costs is increase prices. And I suppose, look, the theme of today was very much is that that's only one of a number of levers. So the first place I think we would ask people to look at will be, consider how we can cut costs, expenses, and we would caveat that by saying without impacting quality or cutting corners. So we really need to focus on what's being, I suppose, consumed within the business. So we've got to look at each cost and the driver of that particular cost. And take, for instance, I suppose, in terms of rooms costs, in terms of, I suppose, kind of laundry there, what's the frequency in terms of, that we're cleaning rooms? If we asked a guest, could that be, I suppose, reduced, and would that give the saving for us? That would be in tune, I suppose, with the guest's requirements. So maybe there's, I suppose, a smarter way about kind of looking at, well, how are we, I suppose, consuming costs within the business? Maybe we can consume maybe less costs within the business.
So actually, so a lot of hotels did that during COVID. Obviously, the number of times they cleaned the rooms reduced. So the question is, can you continue that? And I think that's what you're asking there, Aidan. And actually, I stayed in a hotel recently, and when I checked in, that was what they asked me. They said, when do you want your room cleaned? So I was there for 5 days. As a business traveler, I didn't need my room cleaned every day. I said, no, I don't need it cleaned every day. I think I had it cleaned twice. Where a family of 4, probably a little bit different. But your point is, do we need to go back to the pre-COVID levels of maintaining room or cleaning rooms every day? And again, I think that will depend on the type of property. But these are the questions that you have to ask yourself is, every
I suppose
cost item.
Yeah, and maybe on the restaurant side, again, we've got to look at the menu and look at what are the expensive ingredients. What ingredients have become more expensive, that the dishes have become lower margin, and how can we, I suppose, reconfigure our menus and maybe to have less of a focus on that or more of a focus on dishes which are of a higher margin.
Okay. I would agree, definitely. It's every cost that we're looking at, every element. So how do we move? Go ahead.
Yeah, in terms of the rate being paid, in terms of looking at that, so I suppose you could take things like pens or coasters. Can you kind of substitute something in terms of that's cheaper, than what you're doing at the moment that mightn't impact on quality? So maybe you could do something different, or maybe you can, you can find a cheaper alternative on that one. And obviously, labor is a huge cost, within the business. And how can we, I suppose, deliver the service but take some of the work out of it? Again, going back, I suppose, to the food side of the business, can we look at maybe more prepped, I suppose, food being brought into the property?
So how do we move our price points then, Aidan? Like average spend up? Like obviously, you said it's one point of the conversation is increasing our costs, our menu prices, looking at that, increasing our average room rate. But at some point that there is a point, like how do we maintain and keep our customers? Is that for us to determine like what our value is and really to understand what our value is and the value to the customer? Because at some point you become not valuable, I suppose.
Yeah, and I think we probably have to maybe re-engineer, I suppose, what we're doing, I suppose, within the business and maybe the packages that we're offering. So I suppose that it's not as comparable maybe as what we had maybe 2 years ago or 3 years ago. Maybe we're adding something into the package, and therefore I suppose people are saying, well, I'm getting something more for that. It's a higher quality service, and then we can pay more for that as well. So there are things we can do in terms of moving the price points up. An average spend, I suppose, maybe there's an element that we're keeping certain offers in place, but when the guests are at property, that we're looking to sell, I suppose, more to the guests, and maybe there are more kind of opportunities in terms of going back, I suppose, to the restaurant. The idea of the dessert trolley type of thing that people see, I suppose, certain offers, and that causes them to be taken up. Okay,
thank you. So also finding new sources of revenue and growth, is that possible, do you think, for businesses to do that with, how can they do that?
I think you mentioned, I think previously in terms of COVID and how innovative I think a lot of these businesses were during COVID. So even, I suppose, looking at, food to go was a big part of, I suppose, the sector, during the COVID period. And, can we reintroduce that? Should we be charging for car parking? So are there ancillary services that we can charge for? So there can be new sources of revenue that we can find within the property.
Okay. And then I suppose consider how we best reinvest. And I think this is a key one. As much as we've talked about the lack of, cash flow, at the same time, investment in your business is critical. So how do, what is, going back to your question earlier, should I invest in a carpet or should I invest in new windows? How does a hotel decide what's the best option for them?
Well, I think if the priority and the focus is going to be on the investment must also achieve, I suppose, cost savings going forward so that we can, we can recover our EBITDA margin. I think the focus on items that will deliver on the sustainability agenda, reduce the big costs that are increasing, the energy costs. Are there systems, I suppose, that we can put in place in terms of automate, I suppose, some functions in terms of maybe guest check-in, that there might be a saving on labour. So try and see, in terms of, how will the investment today save over the next 2 or 3 years, and maybe, I suppose, rank, I suppose, the funds which are available, and prioritise ones which will have the greatest, I suppose, impact in terms of cost reduction going forward.
So really look at return on investment of what your CapEx spend is. That's what you're saying to us, and I think that's critical. So let's look at like what's next, I suppose. We have a number of key actions that we would recommend, I suppose, and that we would suggest. Preserve your margin, understand your value, going back to that point earlier about, like you are going to increase your revenues or your rates, whether it's your menu prices, your room rates, but really understand what your value is to the customer. Cost management will be ongoing. And I think Aidan and I, we've talked about that a lot. You have to go and look at every single cost, and what is the value of that cost to your business. So many times I see revenue tools, like technology tools, whether it's a rate shopper or some type of sales function, and they're not being utilized properly. So make sure that if you are paying a subscription for a rate shopper or something like that, that A, you're getting the value out of it, and if you're not, then is that cost worth it? Or make sure that you do get the value out of it. Project consistently and continually now, forecast for the year ahead, certainly, and for next year. I think it's not just setting one budget, it's projecting out. Pass costs on where it is appropriate. I think you've talked about that, Aidan. This was your suggestion, and I would have said, is this not the financial controller, but appoint a spending controller? What do you mean by that?
I think a fresh pair of eyes can be useful, and somebody who is looking at, where is money being spent in the business, how much do we spend on each particular cost item over a 12-month period. And I think that will create, I suppose, a fresh focus on saying, well, can we eliminate some of this? Can we substitute some of this? Can we, offer the service with less of this input, and therefore maybe the head of food and beverage brings somebody else in, because typically it's the financial controller, and what I come across is people feel it's already done, and our costs are as tight as they can be. But more needs to happen, and we need to find more areas in terms of to make the operation leaner, to recover, I suppose, from the impact of these higher costs.
And actually now your light has gone out. You're showing our sustainability in our offices, Aidan, where the lights go out automatically if there's nobody in the room. But actually you made a good point there about lean, and I think that's something that maybe businesses should look at is Lean or Six Sigma, which look to reduce waste, and which are really good ways of reducing waste and increasing efficiency, particularly with the challenges in payroll. And then I think lastly, we have draft a cost mitigation action plan. And what do you mean by that, Aidan?
What I always find is, it's great having a session like this or a session with hoteliers, but unless there's somebody takes ownership of it and I suppose writes down, I suppose, what the actions might be and allocates those actions. So I'd like to see the plan in writing, and you find that if it's in writing, the actions will be followed through. And that there'll also be, I suppose, a view that these costs need to be reported in real time and trackable. And I think if they're reported in real time and trackable in terms of what we're focusing on as part of cost mitigation plan, then we'll find that people will buy in, and there'll be a real focus on reducing, I suppose, that consumption of items within the business.
Okay, thank you. So I think just moving on to questions and answers, that finishes, I suppose, our slides this morning and our discussion. I know we're at 45 minutes now, so Aileen,
That's
back out
great.
there,
That's
back in now.
spot on the time. Thanks a million, guys, and thanks for that. I'm going to jump straight into the questions because we've lots of questions rolling in here. The first one is in relation to revenue and those warehouse tax. So firstly, how quickly do you think revenue will ask for the warehouse taxes to be repaid? And in relation to that, is it usual for a bank to charge for holding excess cash in a current account, namely warehouse tax funds?
Yes, so I suppose in terms of previously, revenue in terms of payment plans would have looked for a repayment plan over a max of 18 months. So they look for a 25% deposit up front and the payment over 18 months. I think there's a recognition that that is too much of an ask for businesses coming out of COVID. And while they haven't given guidance to it, my expectation is that they probably will give 3 years for repayment of these taxes. But part of the criteria for that is that you'll have to have a good record with revenue. So therefore, keeping your current taxes current is important. On the point of banks, I suppose, charging interest on deposit accounts or positive funds from current accounts, yeah, we're seeing more and more of that. And typically, the bank will write to the business and explain, what they have in mind for that. What we're seeing, I suppose, some businesses do is perhaps maybe have a multi-bank approach to that, whereby they're holding, I suppose, money over a number of accounts, maybe 100,000 or less than 100,000 in each, and therefore they're not being charged that.
Okay, thanks for that, Aidan. That's great. And just again on a different, slightly different thread here, in relation to cost. So how long do you think, we're asking you to tell the future here a bit, but how long do you think we'll have these inflated utility costs? And do you think I should look at solar panels or heat pumps? Would it be worth my while to help reduce these costs? And I suppose in relation to that, before you answer, Aidan, there's another question in relation to that, which is there a guide figure for annual reinvestment in the hotel industry for refurbishment, decor upgrade, or capex? So it's a kind of
yeah, no, that's good. I'll deal with the second question first. So the guide figure in terms of what is reinvested would be 3 or 4% per annum. So you'd expect that probably at least 3% per annum would be reinvested. Now, what some hotels will do is they'll put some money aside and they'll do a larger program of work every 2 years or every 3 years. So they'll lock some money away, knowing that they have to do a bigger job, and it's more efficient to do it in that regard. But the rule of thumb certainly is 3 or 4% that needs to be reinvested to keep the property, in a good condition. On the I suppose, investment in energy saving, I think Maria, I suppose, kind of nailed it there, talking about return on investment. So when we were looking at these return on investments probably 2 years ago or 3 years ago, and we could see energy costs coming down for hotels as we were going through the survey year on year, because more and more we're changing out the lights and doing other initiatives within the property. We could see, the savings coming through. But what you're finding is that energy costs have doubled, and are going to stay high. And my own view, I suppose, on that is you can't predict the future. But if we're deciding that a producer of 10% of oil and gas, Russia, is no longer, I suppose, a valued producer, in the market type of thing, or that their supply has been taken out of the market, that suggests that energy prices will stay high till there's some replacement, supplies brought in, which will take some time. So my own view is that we were facing high energy costs for the next 2 or 3 years. I think we were facing it anyway, because I think the tariffs and taxes on energy were going to go up to force through, I suppose, action on the sustainability agenda. So certainly, in terms of the capex and spending, I would be looking at those particular items as being very high priority.
Could I just add to that? Sorry, Aileen. And I think, there's lots of hotels in Ireland that have started to do that. If you're really considering it, talk to them, talk to your colleagues and ask them, what has worked for them, what savings they're starting to see, and especially now that utility costs have gone up, what impact it is for them. And I would agree with you, Aidan, as well. Sustainability isn't just on the agenda for hotels, but it's also on the agenda for your customers. So, I think hotels are seeing that now, where meetings that are getting booked and companies are looking to hotels that have the same, sustainability or ESG agenda that they have. So I think that's certainly something to consider and should be considered in the future.
I think it goes back to the point in terms of what's being consumed by the hotel. Like, we need the information as to where energy is being consumed in terms of location in the hotel, by day or by week. And the technology is there to be able to capture that data now relatively cheaply. And I think that really helps for us to be able to see, well, where is their waste, and how can we eliminate that waste?
That's brilliant, and I suppose it ties in lovely with a lot of the work we're doing in the background, which will be launched over the next couple of months in the whole area of climate action, and it covers everything you've just mentioned. So there'll be a lot of help and support coming your way for that. So moving quickly along then, because I know the time is ticking. So a question here: I've warehoused 150,000 in taxes, and I have an SBCI loan of 200,000. I have 200,000 of cash, but don't know what to pay back and how to pay it back, especially as costs are increasing, and I don't think I can pass on all of my costs. So how should I pay back these loans?
I suppose I'll take that, yeah. So in terms of, I suppose, having a cash, buffer in the business, I think that's really important in the time of uncertainty that we have at the moment, where costs are rising really quickly. So therefore, to de-risk, I suppose, running tight on cash in the business, I'd certainly be looking to agree a longer term with both, I suppose, the warehouse taxes and the SBCI. In other words, take maybe the longest term that they have available. And as we get through, I suppose, this kind of cost crisis that we have at the moment, what you'll find is both with revenue and with SBCI, it's very much almost like a variable facility that if you have money in 2 years or 3 years, you can go in and pay it off at that stage, but you've held the cash in the meantime.
Okay, excellent. And I'm just going to move along quickly. Will the government go ahead with the VAT increase in September, or will inflation pressures make them postpone it? It's another good one for you, Aidan. I'm sure you'll have the answer for that.
Yeah, I guess the timing of it is kind of unusual in that it's the end of September, and I suppose that the budget is usually October. So I think it was designed probably on purpose to be the end of September, so that it would click back in at 13.5% from 9%, before they got into their budget arithmetic. So I've heard, I suppose, nothing to the contrary in terms of an intent to hold the 9% for longer. But looking at the numbers, and I suppose the impact of costs on what are high cost businesses, I think that's probably a very good argument, and there'll be a lot of lobbying done between now and the end of September.
Okay, brilliant. Thanks for that. And just another question in. I base this year's budget on 2019 costs. Should I change this to 2021, or how do I do another budget?
I'll do that, actually. Yeah, just I suppose, like most places did 2019, and that was probably the right thing to do, is to use 2019 as the base year. But like I think what we said earlier is forecast, like you just have to be forecasting. So you've set your budget, you keep your budget, but change your forecast, and that'll be really on real time, because that's, the costs now are increasing. There's a change now. So I would say, do that change your forecasts or update your forecasts on real time as much as possible, because you'll know what the prices increases are now. There's no point in looking at 2021, but keep your 2019 budget. It's still good to have that, that benchmark, I suppose, or that base.
Okay, super. Thanks a million. We're nearly down to the line. There's just 2 more questions in. I'm turning away business because I can't get enough staff. What can I do if there is no way of getting to pre-COVID revenue levels?
I don't know which one of us wants to answer that one. you know, that is the biggest challenge for the industry this year, I think, well, is staffing. And it's for a lot of sectors. It's not just the hospitality industry. I think, and it, again, that really goes to looking at your business, and you really have to look at your business. If there's, you know, and this happened during COVID, if you can't open certain outlets on certain days, like look at the impact of that. How can you move around your business? Like, you know, can you close your restaurant a couple of nights a week, and can people eat in the bar? Can you change your menu? Again, I go back to that Lean or Six Sigma, that has an impact. Technology, can technology help? Hayden and I were talking about this the other day. I stayed in a hotel where they had, you know, the tablets on the restaurant, and it was an airport hotel, and it suited me just fine. So there was one wait staff member, and I ordered on the tablet and paid on the tablet, and they just brought me my food and my drink. Now, obviously, that's probably not going to work in a 5-star hotel, but look at your business. You know, like check in with your. Can you check in online without having to go up to a front desk? Can you use a key? You know, your phone key, like, and those are the investments that Aidan was talking about, that technology investment, or those investments. It's a challenge. None of us have the answers, but you do have to be creative. And I think in the long term as well, as a sector, we need to, you know, really look at employee engagement and really change the perception of the sector. It's a great industry, like it really is a great industry. So we would love for more people to appreciate that, and I suppose for the industry to make it an engaging place to work.
Okay, great. And I'm just going to ask the last question, but I will have to cut you short on it, Maria. What can I do if I'm concerned about the ability to repay my bank loan? Should I go to the bank to extend the term of the loan? And I know our last finance webinar, which is up on our site, covered a lot of this stuff. So if you can give me 30 seconds on that one.
Aidan.
Yeah, I think in terms of engagement with the bank, you know, make sure that you have your forecasts done in detail. I think banks are not looking for any kind of surprises at the moment, and therefore, if you feel that you're going to be under pressure making repayments, I think the earliest that you can go to them, the better, and they will have a mechanism to be able to address that and deal with it and create a little bit of breathing space.
Okay. That's brilliant, guys. That's actually bringing us right down to the top of the hour. I'd just like to take this opportunity to thank you for your time today and for everybody's really active engagement. We've had really great questions come in. Could you please take a moment to give us your feedback on the poll on the screen? It just helps us to monitor how we're doing. A huge thank you to Maria and Aidan from Crow for their really great expertise and such practical guidance and advice. And also I'd like to thank and a huge shout out to my backroom team who without their help this webinar, you know, would be difficult to bring forward. And huge thank you to my team in enterprise development. Our next webinar in the Money Matter series will take place in the autumn, where we will delve deeper into the topics affecting you at that time. So we really hope you can join us for that. Thanks very much.